Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. So it's been a few weeks since we did our latest show, but we still have the trade on for EWJ. We'll go over how that's doing, and then we'll talk about this week's topic, which is trading index options using ORATS data. We have some special techniques and strategies we'll go over with you today. Matt, if you're ready, do you want to get us started by reviewing the EWJ Iron Condor we traded a few weeks ago?
Sure. Thanks for the intro. So here's EWJ in our positions. EWJ has gone up a bit. It's down a little bit today. So we need it below 69. It's about 69.97. So you can see it's kind of drifting out of our area of green, out of area of comfort. But we've got a couple weeks left. So you could see that. It's kind of interesting to be able to click on it and see the position there. You could also look at the trade builder and make sure it still looks okay to you. There, if you recall, Tyler, we did a scan to try to identify the largest discrepancies between implied volatility and historical volatility, and it certainly looks like EWJ is continuing that trend there. Still feel good about the trade. Just need the problem with the Condor is that it can, it's once it gets trending, it could go get you. So we're hoping that it comes down. But anyway, so we still feel, like I said, we still feel pretty good about the trade. So we have a couple weeks left there. So that's the trade. I think my office mate wants to leave, so let her out. All right. Yeah. Without ado, let's talk about indexes. Anything you want to start with before I jump into that, Tyler?
Yeah, I mean, index options are, they can be a little tricky, depending on how you navigate the price, right? So there's the implied futures price, right? And what we do at ORATS, we do a lot of interpolation and stuff like that. And so we use an interpolated implied price to calculate, our volatilities and stuff like that. And so what we're going to show you today is how we calculate that, sort of what it looks like, why we do that, and why it's a better technique. And go over tickers like SPX, VIX, NDX, and some of the other tickers we have available in the backtester and option scanner that you can trade just like any other ticker on the market.
Yeah, good point. So let's talk about some of the differences with SPX, and the reason that we're having to go in and solve for each expiration is, there's no underlying, so to speak, for an SPX. So whereas, even ETFs and stocks have underlying prices, these are cash settled, and they have associated futures prices that the options are based upon. So typically the futures prices are just kind of the standard 3-week or third week of the month expirations out there. But as you know now, there's a lot more expirations. So there are so you have to kind of interpolate and solve for what the market is implying to be a price. So the typical indexes, the most popular ones are SPX, is the S&P 500 with the associated SPY ETF. NDX is the associated QQQ ETF. I should also mention that SPX has a smaller brother, XSP. So does NDX too. It's escaping me right now. My friends over at NASDAQ are not going to be happy with me forgetting. And then there's the VIX too. So the VIX is really interesting because there's quite a term structure to the VIX. And the thing about the VIX is, since it measures implied volatility, typically what we see in this skew pattern here, where the low strikes are on the left and the high strikes are on the right, it's opposite, meaning usually a skew for a stock or ETF or index slopes this way. Gold, in some respects, VIX skews the other way, because as the VIX goes higher, the volatility becomes higher. So that's why there's a skew there. Most stocks, as the stocks start going down, the volatility gets higher, which is why there's a higher volatility for stocks and for ETFs. But the VIX is different. The VIX is also different in that there's a pronounced kind of skew to it. If you go to some good services is the VIX Central, and VIX Central, you could see how, here's March out to October, and you could see how much lower the front months are than the back months. The VIX, of course, measures the implied volatility of the S&P 500. And as you go out months, the volatility is lower in the front and higher in the back. Now, they don't match exactly. Obviously there's some interest rate assumptions and such, but so that's the VIX term structure by VIX Central terms. I'll show you we have our own VIX solve, and you can see it's pretty close to what VIX Central does. We solve for the VIX, and what you're trying to do when you solve for it is, there's put call parity, so you could see the calls and puts don't always line up. And if you go to some of the lazier platforms out there, they won't solve for a futures price, and you'll see the call implied volatilities are very different from the put implied volatilities. And with put call parity, this should never happen. So you should always try to solve for that, the best futures price you can for each expiration, because it's not implied volatility that's ever going to be different, because it's, you could always do an arbitrage there. A call equals a put with the stock, and so you could arbitrage out implied volatilities. But if you ever see the implied volatility is different for calls and puts, it's usually has something to do with either interest rates or dividends. So there's some type of a payout that will affect the stock price and it not lining up. Also a thing, now this doesn't really relate to indexes, but it relates to some thinly traded stocks. It's called hard to borrow. And what hard to borrow means is people want to short certain stocks, and the way that you physically are able to short a stock is you have to go get the stock, borrow it from someone, and sell it. Now, that's fine for a while, but until everyone's trying to do that, and then there's not that much stock left, and the people that actually own the stock could charge a higher price, which is so it gets higher and higher and harder to short stocks that have a lot of short interest to them. So Tyler, that's the first kind of step, is that solving for stock price. Does that make sense so far?
Yeah, it does, and that makes a lot of sense why that stock price changes over the course of future expirations. And you see that in the options chain down below, and how that sort of reflects in the volatility.
Right.
In this is very important when doing back testing, right? Because you want to have accurate, not just prices, but volatility metrics as well. And so that's part of the whole 4 pillars that we have, and backtesting is a very critical part. So we want to make sure to be very accurate in that respect.
Yeah, you bring up a good point, because it really does affect the Greeks if you don't have a good solve for the implied futures rate. So you want to line up the calls and puts, and that gives you better Greeks to trade from. So I should also mention that there are some benefits to trading these indexes. The first of which is it's cash settled. So a lot of traders, especially with smaller accounts, worry about getting assigned stock. So you get assigned stock when the stock, when you have a short call, or that finishes in the money, a long call that finishes in the money, you're going to get long stock. A short call, you're going to get short stock. And then long put, you're going to get short stock assigned to you if it finishes in the money. And a short put, you're going to get long stock assigned to you if that finishes in the money. Or someone with American style options, you could exercise those early. And really, the reason that you would exercise early is if the additional interest rate that you would get is greater than the offsetting, but in this case, or call, and then, or if there's a dividend, the offsetting put for that particular strike is less than the dividend that you would receive. So you have this risk of getting assigned, and with American style options. Now, indexes have European style options, which means that they cannot be assigned earlier than expiration. And they also assign not into stock, like any of those ones that I mentioned. At expiration, you would get delivered the actual stock, but the indexes deliver in cash. So if it's $1 in the money, you'd get $100, or so anyway, it assigns in cash. So a lot of people prefer that. There's a lot less risk, because if it's one of these huge stocks, it might be $100,000 that you need to come up with to handle the price of the stock. Whereas if it's cash settled, it's $100 one way or the other. So that's one of the, I think, benefits of trading indexes. Also, there are some tax benefits as well. There's some long-term capital gains. Of course, you have to look into this on your own and make sure that it works for you. But there are some benefits there. So what I'd like to do now, Tyler, unless are there any other points that you want to go over just before we get into scanning for or looking for a strategy on these these indexes?
Yeah, let's jump into it.
All right. So what I was thinking is, the market's at all-time highs. Some people are getting short, but there's a lot of risk both to the upside and to the downside. So what I want to do is, I just for me personally, I have some some short leaning strategies like long put calendars. So I like to have I'll put on an index calendar that benefits if the market was to go up. It's relatively inexpensive. Like if you bought a call on NDX, let's just go out 10 days and look at what calls are going for. So NDX is 18,000. So people might not ever think about trading the NDX, but with this strategy, you can think about it at least. It's a little expensive. So so as you be very careful trading these, but like 100, you don't even see these prices in most option change, but it's $192 for an at the money NDX 10-day option. So hugely expensive. However, if you do a calendar, kind of an out of the money calendar, the price of these come way down. So let's go to the option scanner, and let's go to just a call calendar and NDX. This is just an example. I'm not going to do this as our trade today, but I just want to say that if you do one of these calendars out of the money, it's $16, so $1,600 total for this. 10-day, and that you could see the prices of the underlying. So, this is actually a viable strategy. You could trade NDX using this type of a strategy. However, what I'm going to do whenever so if I'm looking for kind of a neutral, or this is kind of a neutral strategy I'm looking for as a calendar. So I'm going to look for SPX calendar, see if any happen to pop up today. And this will be here's one right here. How all kind of offset some of my shorts. Now, you can see how this is even less expensive. So let's take a look at this calendar. So this is, in our trade ideas, what we do is we go through all of our back tests and pick out what we think are the highest rated strategies there. And of course, it has to be in the current environment or no environment. And so this strategy looks decent to me. Very inexpensive, $165. And then this thing can pop too. So this thing, you could make $2,000 and you're only risking, it's about 10 to 1. Yeah, there's 10 to 1 risk reward down there.
So you use this strategy in sort of a bullish market where you're sort of a little leery about the market continuing to go up, but you don't want to bet fully against the downside.
Yeah, so let me just clarify a little bit. I'm not bullish on the market, but I feel that there's a chance it could go up substantially. And I want a cheap option or a cheap strategy that can protect me if it goes up.
Right.
If it stays the same, I'm not too bad because I have these put calendars. But if it goes up, I lose, and with my put calendar. So I want to find something that if the market goes against what I'm thinking, I'll make a small bet, and the payoff is really good, so I could live to keep being short the market. The tough thing about this market is everyone hates it, which is why it just keeps climbing, I think. But Powell's speaking twice this week. I really think you got to have some downside. So I do have quite a bit of downside, but I want some upside just in case something happens here. And I think this is a good way to do it, like an out of the money call calendar. And even if this front month expires, you still could be long this call. So something could happen in that 3-day span in between those. So this is why I like this type of strategy. Typically, you get filled. We'll go up. So it's, theoretically, it's only worth $1.61. This is really good to look at, by the way, and it's usually pretty accurate. So we'll pay $1.70. So we'll give them some money for this. Typically, these markets are somewhat wide, 40 cents wide, so you're going to have to give them a little bit more. Probably get filled at 165, but we'll force this out. So we'll check this out. This will be our trade for the week, Tyler. And then, we'll check it out next week to see how it does. So this is it going in our paper trading. And so it was filled. And so we'll check this out. Marked at 165, but we paid 170 for it. Again, that's what we gave up. So like I said, it's not like I'm bullish, but I want to have a strategy that can protect my overall bearish outlook if the market goes against me, and I'm willing to spend what is a kind of relatively small amount compared to the other trades that I have on.
Yeah.
Yeah.
That makes sense.
That's our So we'll put that trade in and track it.
Great. Do you want to look at the trade history of that really quick? See where it was at maybe this last week or so, or?
Yeah, it's a good idea. So the trade history that Tyler's talking about, you just put a trade in the trade analyzer. Go track the trade history for these, and what this will do is it'll go get the minute-by-minute history of a particular spread or trade, and you can see how, like right now, it's $1.65. It was as high as $1.75, and if you go back a few more days, as long as this thing was in existence, meaning these expirations were there, we'll see that
Yeah.
So it's
It looks
kind of,
like it only came up a few days
yeah,
ago, so hasn't been
yeah. So
around long.
right. So it's within this range. So like I said, this will really, this will really, this trade will really perform, up here, and especially around our strike. What you wanted to do ideally is to go to 52.15 and expire there. So at that point, that's when it becomes like $1,600 trade.
Yeah. All right. Do you want to show, we have some, I wanted to go over the trade ideas just a little bit more, like the concept of them, because they're really neat that you can go to that tab and sort of look at all the back tests that we've done, because all of our trade ideas we've back tested. And that's one of
Right.
the,
Yeah.
one of the
Yeah.
hallmark features.
Let's do that. It's a good point. So let's talk about how we get those trade ideas. So first we start with, we have 65 million, 66 million back tests in our database, right? So we've recently added, and now we have like 111 of the top stocks out there. And what we do is we'll say, okay, well, what are some of these, what are some of the best strategies? This is just one strategy for SPY, but we'll look for all of them and we'll rank them against each other based on, return on risk. And we have various rankings. So the rankings you could read about here. We look at drawdowns, we look at monthly returns, annual. So we want the best return on risk type thing. And we also want, in the trade ideas, we've asked the database for anything. It has to meet the criteria that we're in right now, which is, meaning a VIX is below 15, the SMA, the smooth moving average, is above our 50-day or 200-day moving averages. The RSI is overbought. Implied for percentile is low. It's in the lowest third, and the slope percentile, which is the puts versus the calls, in the lowest third. So it has to have two of these, and we back test all those. So if I click this on, it's going to now apply that to the SPY iron condors here. And so you can see that this is overbought and the percentile is low. That's the highest rated iron condor there is right now. So from this list and from all these back tests, all these particular names, then we go ahead and grab those and sort them by whether the strategy is a neutral strategy, like a calendar, a condor, or some iron butterfly, or a bearish trade, like a long put, short call spread, or a bullish, bullish trades like a long call, short put spread. So those are the various ways that we organize those strategies. And then you could sort them based on either probability of profit. I like to use a forecast edge. So that's, again, that's that calendar. That's why that came up. You could use smooth edge, which is our drawn curve against what the value is in the market. And there's a few other things that you can look to, sharp ratio of the strategy, what's the best sharp ratio, et cetera. But like I said, I want to get edge in this trade. So what we do in order to show this table is we find the best strategies, and then these strategies have to have trades that meet the criteria for this particular call calendar. Does that make sense, Tyler?
Yeah, it's really neat.
Yeah, it is neat.
Yeah. All right. Is there anything else you wanted to cover on the indexes? Index options?
No, I think that's it. I mean, the big thing to know is it's safer in a lot of ways, even though it's intimidating because the prices for these are high. But there's also a way that you could use these using calendars. So and the calendars are quite inexpensive, especially if you're doing an out of the money call calendar or out of the money put calendar. Today we're protecting a short position by doing a call calendar, but you could do the same thing for with a put calendar as well if you're slightly bearish. So, like I said, once you start getting used to the indexes, once you see go through very small, I do a lot of paper trading because there is risk just because it's a highly priced index. But once you're got your feet underneath you, the indexes can be a lot actually less risky than some other types of strategies using stocks or ETFs, where you get assigned the shares, and that gets a little bit stressful and messy for traders. So yeah, give the index a shot when you feel ready.
Very good points, Matt. That's a lot of good information. Yes, so you can try out all these tools, ORATS.com, and if you have any questions, you can leave comments below. We're always checking our YouTube channel and our inbox if you have any questions. But thank you to Trader for hosting us again, and we'll see you again next week.